September 23rd, 2021 full board meeting to order. And before we begin, I wanted to make an announcement that this is a public meeting of the Philadelphia Board of Pensions and Retirement, and it will be conducted as a virtual meeting using Microsoft Teams conference technology. Pursuant to section 21-1503 of the Philadelphia Code, this meeting is being recorded and the recording will be made available to the public online on the board's website within 10 days. Please note that you consent to such recording by joining the meeting today. Please also note that the meeting software will log the email address or the telephone number that you use to join the meeting, and therefore the email and/or telephone number that you use may become a part of the recording that is made available to the public. And I'll also ask that trustees, when speaking or voting, to the best of your technological abilities, to have your camera on so that we can both see you and hear you. And with that, we'll begin. So first, I'll ask the board to approve our virtual procedures for today's meeting. A motion to adopt these new procedures has been made and seconded. Is there any discussion on this item? Hearing none, we'll move to the roll call. Brian?
I approve.
Leontine?
Approve.
Vanessa?
Approved.
Sherilyn?
Approve.
Carol? Do we have Carol Stooks-Baylor?
Yeah, approved.
Thank you. Kellen?
Approve.
And Ron Stagliano.
I approve.
Motion carries unanimously. Item 2, a motion to approve our minutes from the August meeting has been made and seconded. Any discussion on this item? Hearing none, we'll go to the roll. Brian?
I approve.
Leontine?
Approve.
Vanessa?
Approved.
Sherilyn?
Approve.
Carol?
Approved.
Kellen?
Approve.
And Ron.
I approve.
Motion carries unanimously. Item 3, a motion to approve 100 pension applications and 67 withdrawal applications has been made and seconded. Any discussion on this item? Hearing none. Brian?
Jackie, you broke up real quick. Can you just repeat that? I'm having a
Sure.
little trouble with the audio here.
Sure. We're on item 3, and it's a motion to approve the 100 pension
Okay.
applications and withdrawals.
Understood. I approve.
Thank you. Leontine?
Approve.
Vanessa?
Approved.
Sherilyn?
Approve.
Carol?
Approved.
Kellen?
Approve.
And Ron.
I approve.
Motion carries unanimously. 4A, a motion to approve the service-connected disability benefits for Barrington v. Hilton has been made and seconded. Any discussion on this item?
I'll make a motion to table.
I'll second that motion.
Is that for clarification, Ron, for 30 days?
That's correct, yes.
Okay, there's a motion that has been made and seconded to table 4A for 30 days. Is there any discussion on the revised pending motion? Hearing none. Brian?
I approve.
Leontine?
I approve.
Vanessa?
I approve.
Sherilyn?
Approve.
Carol?
Approved.
Helen?
Approve.
And Ron.
I approve.
The motion to table carries unanimously. 4B, a motion to approve the service-connected benefits for Dwayne Spreel has been made and seconded. Is there any discussion on this item? Hearing none. Brian?
I'll abstain.
Leontine?
Deny.
Vanessa?
Denied.
Sherilyn?
Deny.
Carol?
Abstain.
Helen?
Deny.
And Ron.
I abstain.
The motion fails 0-4 with 3 abstentions. 4C, a motion to approve the service-connected disability benefits for Gene P. Malin III has been made and seconded. Any discussion on this item? Hearing None. We'll go to the roll. Brian,
I'll abstain.
Leontine,
deny,
Vanessa,
Deny.
Sherilyn,
Deny.
Carol,
Abstain.
Kellen,
Deny.
and Ron.
I abstain.
The motion fails 0-4 with 3 abstentions. 4D, a motion to approve the service-connected disability benefits for Sandra B. Wiley has been made and seconded. Any discussion on this item? Okay. Brian,
I'll abstain.
Leontine,
deny,
Vanessa,
Deny.
Sherilyn,
Deny.
Carol,
Abstain.
Kellen,
Deny.
Ron.
Abstain.
The motion fails 0-4 with 3 abstentions. 4E, a motion to approve the service-connected disability benefits for Sean King has been made and seconded. Any discussion on this item? Okay, we'll move to the roll. Brian,
I approve.
Leontine,
approve,
I
Vanessa,
approve.
Sherilyn,
Approve.
Carol,
Approve.
Kellen,
Approve.
and Ron.
I approve.
Motion carries unanimously. Moving to section 5A, a motion to approve the service-connected death benefits related to Alex Robinson, the deceased, has been made and seconded. Any discussion on this item?
Yes, Jackie, I would like to make a motion to table this for 30 days. Councilman Heenan's ordinance that he supported was actually in place after the doctors reviewed the evidence. And so I think it would be prudent to have the doctors take a look at this case again and then provide their opinions based upon the new standard that's been set by Councilman Heenan. I mean, that standard includes a presumption. It includes a requirement that there be an in-person work period of at least 3 weeks. And there are also various other provisions that the doctors did not have an opportunity to review. So I think it's important for this to be tabled so that they can review this case in light of the new standard.
Okay. Is there a second to the motion to
Second.
table this case for 30 days?
Second.
Motion.
Okay, a motion to table 5A for 30 days has been made and seconded. Any discussion on the revised motion?
So Jackie, just let me piggyback off of Charlene, and I'm like, I understand what you're saying, but the death certificate said the main cause, the primary cause of death was COVID-19. So I don't see what the issue is about tabling. Although I'm going to go along with the table, I'm trying to understand why, if the death certificate says the primary cause of this man's death was the condition attributed to COVID-19, why the doctors didn't pick it up and trying to make his secondary illness the primary cause of his death. That's the problem I'm having with both the doctors. So you're going to ignore the death certificate and put down because he was obese and he had this and he had that, when it clearly states that the main cause was. And Heenan bill also said that the performance of such members' duties or solely from the COVID-19 infection. So it should be the members' death can result solely from the performance of that. But it says the primary cause of his death was potent hemorrhage, COVID-19. So based on that, but I'm gonna go ahead with the table because I want to see what happens. But it's clear to me that something not right here.
Okay, thanks for unpacking those concerns, Carol. So a revised motion has been made to table 5A for 30 days, been made and seconded. Hearing no additional discussion, I'm going to move to the roll. Brian,
I approve.
Leontine,
approve,
Vanessa,
Approve.
Sherilyn,
Approve.
Carol,
Approve.
Kellen,
Approve.
and Ron.
I approve.
The motion to table carries unanimously. Moves us into old business. Is there any old business before the board? Okay, we'll move to new business and the executive director's report.
Good morning, everyone. The state audit, every 3-year audit, the annual audit, and the actuarial data requests are all going on simultaneously. So they continue. The annual auditor from Clifton is actually coming in next week on Monday. So all of those things are happening at the same time. And so far, everything's moving along. A subcommittee of this board did meet with Councilperson Parker recently concerning the draft stress test legislation. Those who participated saw my email yesterday with a couple of provisions that we believe are important to be included in the legislation to adequately reflect, based on our discussion, that the board has already been doing this and has been their practice and for years to do this. So we are waiting to hear back from the councilperson's office after consultation with the law department. Any other additional comments that anyone has, please forward them directly to Rachel in the councilperson's office. Everyone should be happy to know that based on some strategic changes that Shamika made to the process, along with Stacy and Steve and Shahid, and staff, is that the timeline for retirement appointments is now down to between 2 and 3 weeks. So that has gone very, very well. We've also brought on 2 more counselors and a couple of other administrative staff, and a couple existing employees were moved to promoted to positions where they were higher on the list. So we've again increased staffing, tweaked the process a little bit, and of course, the airport early retirements have been completed, and the larger influx of retirees has started to slow down somewhat, although it's still increased. I'm going to say it was 21% previously. It's still at a higher percentage now than normal, but not quite at that level. So that's good news. And as always, your feedback was helpful in us, saying, okay, let's tweak this, let's tweak that. We can't do it, on our own without feedback from the members and or the trustees. So I appreciate that. And but again, I want to thank Shamika and Stacy, Steve for leading this effort. They did a very good job. The trustee election, the ballot deadline has passed. That was on the 21st. The live counting of the ballots is on Tuesday, the 28th, on the 17th floor, starting at 9:30. I'm told by the election provider that that should take us till around between 1 and 2:30, somewhere around there. So if you don't want to get there right at 9:30, you can come a little later if you'd like, in order to see the results. The swearing in of the newly elected members will be at the meeting on October 28th. So that's it. That's all I have on that. And it's actually everything.
So, Fran, you said the swearing in of the new trustees is going to be November 28th?
Did I say that? I should have said October 28th.
Okay, all right. Maybe I heard it wrong, but I thought you said.
No,
right.
I could have said that, Carol. Who knows?
That's
Yes.
all right. I don't mind postponing to keep my former trustees on for a while.
We can make it on Thanksgiving, right? We can have a Thanksgiving in there. Yeah, no, it's October 28th, the next board meeting. Yeah.
All right.
Thanks, Fran. Any other new business before the board? Okay, we'll move to the litigation summary.
There are no new matters since the last meeting.
Okay. Motion to adjourn has been made and seconded, and hearing no objections, the motion carries unanimously.
I'm sorry, can I say one more thing? Back
Sure.
to Fran report. I'm sorry, I'm slow today, y'all. Be happy. Fran, I just want to thank you for going to the meet with us. Brian went with us to meet Councilperson Sherelle Parker. and the city controller also met. For me, Fran, information you send out, I just want you to make sure that whatever the trustees discussed at that meeting, that's what we want included in the bill, okay? So I'm not gonna respond back and forth with Rachel and with the council person, but I thought we walked away with a fair agreement from both sides. So I think the information that we wanted in the bill should be in the bill. Brian, what you think?
Yeah, absolutely. I thought we were very clear that our concerns, and they weren't met. I mean, she talked right through them, and that's fine. But then you see that in writing that she disregarded them completely. So if she wants to go that route, then I think we have to kind of go back and let her know that. Absolutely.
And thanks, Jimmy, too. So I appreciate it. James.
Thank you. Thanks to all of you for joining us and you know, asserting your positions.
Okay. Any other new business? Okay. Motion to adjourn has been made and seconded, and hearing no objections, we're going to move into the deferred comp portion of the meeting. And our first item is to approve our minutes from last month. A motion has been made and seconded. Any discussion? Hearing none, we'll move to the roll. Brian?
I approve.
Francois? Or Sherilyn?
I approve.
Thank you. Leontine?
Approve.
Vanessa?
Approve.
Rebecca? Okay. We'll go back to Carol.
Approve.
Kellen?
Approve.
Thanks. And Ron?
I approve.
Okay. Motion carries unanimously. That moves us into the plan update and activity report.
Brad Urbina, Nationwide.
Good morning, everyone.
Good morning.
As of August 31st, the deferred compensation plan ending balance was $1,744,061,553.39. That's about 1.8% increase than the month of July. Total plan participants with account balances is 24,513, 31 more, excuse me, than last month. Actively deferring is 19,118. That's about 25 more than July. New enrollments, 63 is the total number that was received. When we look at year to date, excuse me, year to date, we received 798 year to date new enrollments, which is 12% above last year. Inactive, 5,395. That's about 6 more than July. In the 401A plan, we did receive the 401A payroll for the fiscal year of 2021. The ending balance in August was $2,057,509.41. There are 894 total participants. That's over about 109 than the previous month. In terms of the call volumes, the total call volumes handled was 2,959. That's 44 more than month of July. In terms of call volumes in general year to date, we are down by 10% since last year, which is good because more and more folks are leveraging the web account and the resources and the planning tools. As of July, 17,059 participants have set up a web account, which is about 70% of those participants with total account balance. In terms of percentage options, in August, the total is 922 participants. That's an increase of 51 more since the month of July. And Roth 457, which is after tax contributions, continues to be popular. The total participant count is 3,574. That's 121 more participants. And if you look at the age demographic, it's popular amongst the 30 to 39 and the 40 to 49. They have the highest penetration.
And the total plan assets in the Roth 57 is $15,897,512.94. That's about 6% increase from last month. Happy to answer any questions before I pass it on to Brad for the service summary. Brad?
Thank you, Bina. Good morning, everyone. So for the month of August, the local team conducted 111 individual one-on-one consultations. Those resulted in 16 enrollments into the plan, and 28 of those consultations utilized the My Interactive Retirement Planner tool. The team conducted 6 new employee orientations during the month of August, and there were 18 seminars / webinars, some in person, some virtual, and those resulted in 260 attendees. I did want to report on a marketing campaign that was conducted. It was sent out on September 3rd, which was the email that was sent out to folks that were eligible to receive a match in Plan 10 and Plan 16, but not receiving that. So there were 687 total emails that were sent. And of those 687 emails, 200 of the folks that received those emails opened it. And 54 of the 200 that opened it clicked on a link that were in that email. And those clicks resulted in 17 folks enrolling in the 457 plan when they clicked on that email. Overall, from a marketing perspective, those are very good numbers in terms of folks clicking and opening the email. Be happy to take any questions on that or any of the other data that I shared.
Thanks, Brad and Bina.
Yeah,
Any
Brad,
questions?
Brad or Bina or Jeff, I have a question. It's Fran. Upon our inquiry, we were notified of a rough timeline by Jeff of Nationwide's intent to declare the rate for the next quarter. Remember, we've had the 2.8% rate for the guaranteed fund for the last 2 quarters. And I think Jeff gave a general timeline of maybe a week from now in Nationwide declaring the rate for the quarter starting after December. So January 1. And being as you review the assets and the continued increase of the assets, I just want everyone to be aware as these assets increase, the secured fund assets are increasing, and that 20 basis point decrease that we were forced to absorb is additional profit for Nationwide. So I want the board to know that, and I want Nationwide to keep that in mind as you contemplate the next rate going forward for the next quarter, because every decrease in rate is increase in profit for Nationwide and a decrease in returns for the members. So I want everyone to be aware of that before we get too far into this process going into the next quarter.
Thanks, Fran. Any other questions for Nationwide? Okay, thank you, Brad and Bina. And that moves us to item 3, the Harbor Capital Appreciation Fund CIT review.
Good morning, everyone. Recall at the June meeting, investment staff reported that we were notified by Harbor that the plan assets and the Harbor Capital Appreciation Fund were eligible for a lower expense ratio, and the Harbor Collective Investment Trust, or CIT. The expense ratio for the CIT was 43 basis points compared to the 67 basis points that we're currently investing with the institutional class of the mutual fund. And, we further at that time informed the board that there was a retirement option, which was 59 basis points, which is also a mutual fund. Given some of the concerns around the regulatory differences between a mutual fund and a collective investment trust, the law department was asked to provide a legal analysis of some of those differences and risk. So Adam is here to provide that review. Adam or the law department?
Sure. Good morning, everyone. As the memo lays out, there are some differences between CITs and traditional mutual funds. Largely, CITs are only offered to a specific class of investors, and the board is eligible as one of those limited class of investors. There is some significant differences in the reporting requirements, given that mutual funds are SEC regulated and the CITs are not. They fall kind of outside that that typical regulation that you'd see with all the other mutual funds that we have. So the plan participants who would be eligible to invest in the CIT should be aware of the differences in reporting requirements that they would see. So
Are there any questions?
I'm sorry, Dominique. So I was just reading through, but what I did want to clarify is that I think this is an option that the trustees have to offer. We know that I know in talking with Chris, who's worked with some other funds around the country to discuss, their implementation of CITs, that this is something that is, implemented by other large investor classes like us. But the question is for the trustees whether this is something that at this time they feel is a good option for the plan participants, and that the fee breaks that we would receive are balanced out by the difference in regulatory requirements.
From what I read in there, the law department punted this back to the board, right? We asked for an assessment of the risk, right? We understand as fiduciaries the risk versus the benefit. That's on. But we asked for an evaluation of the risk. I don't think in any way that we got that, and that's just my opinion. If you disagree, point to me in the memo where we got that. But I mean, the solicitor's here on the call, right? I don't feel like we got that at all. I think that it was punted back to us to say, hey, you can do what you want to do. Well, we understand that. We wanted some assistance from the law department, which is exactly what I think they're here for, right? So can you speak to where that risk assessment is in that memo, or why it wasn't in the memo?
I will say I see this is similar in my mind to the investment managers that we have versus a private equity fund, that the board has the discretion to go into those, and it in consultation with Marquette and investment staff, weighs the business risks. There's potential for higher returns. There could be lower fees. These are all factors that the board has to weigh. I don't necessarily believe that it's a legal question as to whether this is appropriate for plan participants, if that makes sense. But I do think in the memo I did address largely the trade-off between the cost and the regulatory requirements. So, plan participants are going to see aren't going to see the same documents that they're used to seeing as far as reviewing the mutual fund statements. So CITs aren't offered to the public, so they don't have to spend the same amount of money on these regulatory requirements that the SEC imposes, as well as marketing and other administrative fees. So that's how they keep the costs lower on the CITs. And I think it should have been provided with the memo, but the actual declaration of trust explains the investment process and goes through all of the folks who are involved in the fund and what their goals are for the fund, and provides some details on what the risks are of investing in a fund like that.
Adam, I have a question. How you doing? The the one line in the memo that says, if the trustees determine that the harbor CIT's differing and less demanding disclosure requirements are offset by the cost of the savings, then it goes on to say, the trustees can make that determination. My question is, what are the legal risks associated with the differing and less demanding disclosure requirements? I think that's still part of the outstanding question that Brian was alluding to. Are there legal risks associated? And I will just add this, that unlike when the board makes a decision on private equity or other investments, the board is tasked via the charter with making those investment decisions. And they are investment decisions for the fund as a whole. However, we have over 23,000 participants in deferred compensation. And as you know, whether it's a 401k, 403b, or 457, that area is very ripe for litigation in the areas of fees, offerings, and type of offerings, and sufficient type of offerings, and risk. So I would distinguish the two of those situations. I understand what you're saying, but I would distinguish them a little bit from a risk/litigation perspective. So the question really is, among those differing and less demanding disclosure requirements, which the board will balance with the cost. I mean, the board understands that to do that, but to bolster the analysis, I think what the board would like is the legal risks that are associated with adopting those differing and less demanding disclosure requirements. And I don't see that in the memo. I may have missed that, but aren't there some quantifiable legal risks that you could present to the board in order for the board to assist the board in making that determination, similar to how the investment staff provides as much data as they can on possible investment managers in order for the board to make an educated determination?
Yeah, I certainly understand what you're saying, Fred, and the point about the private equity being different in a lot of ways is well taken. I certainly understand that. I think the fact is here that they're just different. The reporting requirements are different. They're not inherently, the reporting requirements for the CITs aren't inherently bad. I mean, they are required to provide an audited financial statement yearly, and they're held to an ERISA fiduciary standard. So, in a lot of ways, these are, it's not like there's no regulation. This is the Wild West. They're governed by, state banking regulators, the OCC, and a fiduciary standard under ERISA. So it's hard to say that, I feel like it's hard to address, just given the differences in the structure, whether there's a particular risk of, I feel like I'm not explaining this well.
No, that's okay. And I think I'm just reading from the memo where it said, it does say differing. I get that, but it also says less demanding. And I guess that they're the two words, less demanding, that I think I'm kind of focusing on. That's it.
Yeah. So there's going to be more frequent disclosure requirements for mutual funds that are governed by the SEC. So there is more oversight. There's more eyes on it. And given that they're offered to the public, like I said, there's going to be a lot more attention on those reports, whereas CITs are really only offered to this kind of narrow, large investor class. So you're not going to see the same. You're not going to see the same, frequency and potentially detail of reports, but they are still required to provide, like I said, audited yearly financial statements, and are held to that ERISA standard.
So versus the SEC, who's the oversight? What is the oversight mechanism for this besides ERISA? Is it a state? Is it a federal government? Who's the oversight?
So in this case, it's the state of New Hampshire, their banking regulatory system, and then the Department of Labor and the Office of Comptroller of Currency, which is federal.
That's fancy. Comptroller of Currency. That's a good one. Thanks, Adam. I appreciate it.
Yeah, and I understand that there may be some concerns here, and I'm happy to work with the trustees and get this to a place that we're comfortable with the risks here. So we can work through that.
Thanks.
So, thank you. I don't know I'm so confused. Anyway, and I appreciate you working with us. So I'd like to make a recommendation, if I can, that we get some further training on this. But in the meantime, we move to the lower cost mutual funds. Do we have a lower, Dominique, do we have a lower cost mutual fund that we can put the plan participants in until we get more information on the CIT? And
Yes.
we feel comfortable about moving to that without, because without transparency, and I know everybody's looking at the lower fees, but I just don't want to get caught up in something that's in the small print and we missed it and it's going to cause a problem. That's just my recommendation.
There is a retirement share class of the mutual fund at 59 basis points versus the 67 that we're paying in the institutional class.
Same fund, right, Dominique?
That's correct. Identical fund. It's just simply a lower expense ratio.
Brad, what would be the time frame on transferring to that fund? If the board would decide that today.
Thanks, Fred. The next available window would be December 16th would be the date for the transition to the lower exchange fund.
Is that Harbor's time frame or is that Nationwide's time frame?
That would be Nationwide's time frame, as well as allowing for proper notification of the participants. We have to give a certain amount of days notice and communicating to the participants.
Yeah, no, that's fair. Thanks.
Okay. Are there any additional questions before I ask for a second to Carol's motion?
I'll second.
Okay. So a motion has been made and seconded to transition to the lower cost mutual fund option. Any discussion on this motion? Hearing none, move to the roll. Brian?
I approve.
Francois?
I approve.
Leontine?
Approve.
Vanessa?
Approve.
Carol?
Approve.
Kellen?
Approve.
And Ron?
I approve.
Motion carries unanimously. And a motion to adjourn our deferred comp portion has been made and seconded. Any discussion? Hearing none, we'll move into the investment committee.
Thanks. Yeah, let's call the investment committee into order. The first item is approval of the minutes from August 21st. It's been moved and properly seconded that the minutes be approved. I'll call the roll. Brian?
I approve.
Francois?
I approve.
Leontine?
Approve.
Vanessa?
Approve.
Carol?
Approve.
Ron?
Approve.
And Kellen?
Approve.
The motion carries unanimously. We'll move to agenda item 2, which is a private equity investment recommendation for Barings.
Good morning, Rob, and everyone.
Good morning.
I'm gonna keep my comments very brief and then turn it over to Byrne and Marquette. Thanks staff, all the staff members who worked on this investment recommendation. This private equity investment recommendation with First Capital and Barings would represent, if approved, our final investment, private equity or private markets investment recommendation of the year, and would get us to our annual pacing requirements per the approved asset allocation. The recommended amount is $50 million. 4 members of the Barings team, some of whom you've met before as a result of the investment in First Capital One, are here to present. Staff Marquette will be happy to take questions, but with that, I'll turn it over to Byrne for a brief walkthrough, and then the team from Marquette for some additional comments and board questions.
Chris, thank you very much. Good morning, everyone. Staff and Marquette are bringing a recommendation to the board for its consideration today for a $50 million investment in Barings First Capital 2. I'm going to briefly just review the history of the board's relationship with Barings and Barings First Capital 1. I'm going to highlight some specifics about the First Capital 1 fund, review its performance, a few of its holdings. I'm going to then go in and very briefly discuss the fund that we are going to recommend, which is First Capital 2. And then I will turn it over to our friends at Marquette so that they can go through a more granular presentation on their review. Then Mina and her team will come through. For the board's review, let me just highlight that staff and Torrey Cove brought Barings First Capital 1 to the board for its approval back in December 2018. As the board will hopefully recollect, Barings is a wholly owned subsidiary of Mass Mutual Insurance Company, which is a AA rated insurance company that is owned by its policyholders that has over $600 billion underneath management. Mass Mutual went out and purchased Barings, brought it in-house in 2006. Barings has over $300 billion of that $600 billion underneath management. And Barings, in its alternative division, went out and purchased Aldea, which is what Mina and her team are, and brought them in-house for the alternative asset private equity division of Barings back in 2018. Mina and her team have been charged with developing a private equity platform that invests specifically in diverse and emerging managers in the private equity arena. Bear in mind that since the Great Recession in 2008, 2009, the vast majority of capital in the private equity market has gone into the large cap or the higher end multi-billion-dollar sector of the private equity market. Think in mind of the board's relationship with Veritas. Veritas engages in multi-billion-dollar transactions. Mina and her team are looking at buyout opportunities, growth opportunities at the lower middle market sector of the private equity arena. They're investing primarily in looking for diverse and emerging managers that have an enterprise value of less than $300 million. That adds diversity here in terms of our asset allocation within the private market sector of our portfolio. And let me briefly just go through First Capital 1. Initially, it was a $75 million investment. Mina and her team selected out of 1,100 investments that they reviewed over a 3-year time period. They shortlisted 44 and they invested capital in 22 investments, 17 of which were co-investments, which they sourced the deals from general partners, established private equity funds, and they do their own separate due diligence on those investments. And they also purchased 5 investments in the secondary market. As you can see from our reports and Marquette's reports and Barings reports, the performance, 19.3% gross, 15.8% net. The vast majority of the investment is in North America. There are 3 investments that have been made that are outside of North America. 2 are in Europe. 1 is in the United Kingdom. Let me just discuss briefly the fee structure of First Capital 1. It is 85 basis points for a management fee, a 10% carry at an 8% hurdle. First Capital 1 had a 4-year investment time frame. So far as First Capital 2 is concerned, we're looking at the same management team. The difference is we're looking for a $50 million investment. Staff has been able to negotiate the same fee structure as the first investment. 85 basis points on a management fee, 10% carry, 8% hurdle, which normally in private equity, the less money you manage, the higher the fee. We've been able to do a very good job in negotiating, Chris and other staff members, with Mina and her team. Because of the lesser amount of money that we would invest here, the investment period, we've been able to shorten it from 4 years to 3 years with the opportunity to extend it at our discretion, with the board's discretion, for an additional year. That will allow Mina and her team to look to put the capital to work here over the next couple of years. And her sourcing, her due diligence, and Mina and her team is going to remain exactly the same. And with that, I will turn it over to Marquette, unless someone has any questions for myself or other members of the staff.
Just one question, Vern. You talked about where the First Capital 1 investments were geographically, and I think there's a slight difference for First Capital 2. So can you just talk through that?
Sure, Rob. I'm sorry. Let me just highlight. Initially, when we put the money to work in First Capital 1, it was a North American fund. Then with COVID, we were able to, Mina and her team approached us. We were able to then do an amendment in terms of allowing them to deploy a small amount of capital outside of North America. In this case, geographically, it went to Europe, 2 in Europe and 1 in the United Kingdom. So what Mina would like to do in her team is maintain that same opportunity, giving the geographic diversity that is going on, and also some of these emerging managers that we're seeing that are located outside the United States. If an opportunity presents itself, they would like to be able to review it and possibly co-invest in it.
Thank you.
Hey, Bern, I like your distinction between Europe and the UK. However, the question is, why is it better or a good alternative to direct investing as a private equity limited partner to invest in co-investments and secondary markets?
Sure. Good question, Fran. Good question. And if I could just highlight for you and the other members of the board, a direct investment is limiting yourself in terms of, say we were to invest $50 million into, and I'm making this up for the sake of argument, an LLR or so forth like that. LLR invests in a very specific geographic area, here primarily within the Mid-Atlantic region. Mina and her team are able to go out and take a look at, in this case, well over 1,100 different deals dispersed throughout the United States. And giving her reputation and her professional Rolodex, she's in direct contact with the best general partners in the business. So essentially, we're able to get the best of the best. And so far as these co-investments are concerned, these are deals that many of the general partners are raising that have access to capital. They have excess, they need additional capital to put into work. They have the opportunity to put additional capital to work. For us, that presents an advantage because we're able to get into an investment at no fee, no carry, and at a much lower rate than if we were to go with a direct investment. Most of the direct investments are 2 and 20, which you're well aware of. Some of them have approached us at 2.5 and 25%, which obviously we have not brought before the board. So it's a very good question. And also, so far as the secondary is concerned, given the volatility of what we've seen over, I would say the last 1.5 years, 2 years with COVID, this has presented an opportunity. So some of these investments she's been able to pick up and pick them up at a cheaper price, if you will. So all in all, this is a win-win for us.
Bern, although it would be private equity, public equity would be the analogy I'm about to make. I was wondering if it would be comparable to a mutual fund manager who has the ability to invest anywhere versus, for example, a mid-cap value manager who has that specific narrow mandate. Is that kind of what you're saying?
I would agree with that analogy, and my corollary to that, Fran, would be that specifically this would be a manager that has the opportunity to look at specifically the lower to mid market of the equity arena, if we're going to make that analogy, and primarily to take advantage of either co-investments or opportunities that are presented due to dislocations in the market.
Okay, thanks, Bern.
Sure, Fran. And if no one has anything else, Bill, I'll turn it over to Marquette.
Thank you, Bern. Good morning, everybody. Bern covered a lot of this, so I will move quickly, but just hit on a couple other key points that I think highlight why we and staff like this opportunity for a re-up to First Capital Fund 2. So as Bern mentioned, the team here we think has a lot of depth and is really excellent. So this is going to be led by Mina and Alan Ruiz as the two co-portfolio managers, but there's actually a 6-person investment committee that oversees this fund and improves all investments. And they're supported by 19 total investment professionals, an additional 16 operational professionals. So we think they have a very deep team, and that's one of the things we like a lot about it. And it's been very consistent. So the people that are investing Fund 2 were the same people that invested Fund 1. So we think that track record that they've been able to put together is highly relevant. To show a little more detail on the strategy, the expectation is similar to Fund 1 that they'll do about 15 to 25 investments. The majority of those will be co-investments with, as Bern alluded to, the opportunity to selectively do secondary investments when and if there's an interesting opportunity there. And they will be focusing on partnering both with diverse-led GPs as well as focusing on diverse-led underlying companies. And so I think we'll probably talk a little bit more about that, but that's also something they've had some success with within this mandate. I think a good example of this is CARE ACT, one of the first investments they made back in 2019. This is a business, LLR is the sponsor. So LLR obviously is an existing GP relationship with the city of Philadelphia. And the Barings team was able to partner with them and make a co-investment in this business. The business focuses on providing primary care services, and they try and have a competitive disadvantages by locating in convenient locations for customers. So reducing health costs, bringing more health to individuals. LLR obviously is a health and healthcare focused GP. So I think this is a great example of where Barings is going to look for interesting investment opportunities and those opportunities that align well with the GP's expertise. And I think this is a perfect example of the kind of things that we're looking for. And CARE ACT is actually a diverse-led company. So again, kind of partnering with a lot of the things that we're looking for here. Bern mentioned this, but performance Fund 1 is at a 15.8% net IRR. It is early, but we think that this is off to a very strong start. If you look at the underlying investments, all of them are either held basically at cost or have been marked up to some degree. So we don't have any sort of issues with the portfolio as we sit here today. And then again on the terms, and I think, candidly, Bern maybe understated what a good job that they have done. So two things, the investment management fee at 85 basis points, I would say is definitely lower than we typically see for co-investment funds that might be 1%, might be 1.25%. And this is charged on invested capital, not committed capital. So only when they make a capital call and have it invested will a fee be charged. And that is sort of another additional discount that staff has been able to negotiate. And then additionally, the 10% performance fee, we would say, is definitely at the lower end of the range that we see for co-investment mandates. So we think that is also a strong benefit as well. So when we look at this overall, we think that the area is a very attractive area, partnering with an extremely strong team that has done exactly what they said they would do with Fund 1. We feel comfortable that they have the depths and resources to be able to do the same thing in Fund 2. We think this will be a good addition and complement to the existing portfolio. So with that, I'm happy to take any questions, or we can turn it back to Chris and Bern and ultimately to have the Barings team come in.
Looks like we can bring them in. Thank you.
Barings team is in, Rob.
Great. Thank you for coming today. And you can start whenever you're ready.
Perfect. Thank you, everybody. Can you see and hear me?
Yes.
Okay, wonderful. Well, thank you, City of Philadelphia board, staff, and Marquette for having us here today. We're excited to share with you what we've done for the City of Philadelphia and First Capital. First, as a quick introduction, my name is Mina Pacheco-Nazemi, and I serve as the co-head of Barings FCI, also an IC member, and lead PM for First Capital.
Hi, everyone. Great to be back. I'm Alan Ruiz, Managing Director, Investment Committee member based in Los Angeles. Help lead our private equity investment vertical, and I'm also a portfolio manager for the City of Philadelphia alongside Mina. I've been in private equity since 2007, was actually Mina's analyst, and have primarily focused on the lower mid-market since then.
Greg Long, I'm the client portfolio manager, supporting Mina in the funds and co-investments business, helping with prospective and new clients as we launch new initiatives, of which First Capital 2 fits the profile, in which we're very excited about talking to you about today.
Thanks, Greg, and good morning, everyone. My name is Stephen Walker, and I'm responsible for relationship management activities in Barings Northeast market. I joined the firm in 2019, and over the past 16 years have worked in similar roles at Wells Fargo Alternative Investments and Brown Brothers Harriman. Before we begin, I just want to echo our sincere thanks to the City of Philadelphia and Marquette for the opportunity to be here today. I'll start today's presentation on page 4 with a quick update on Barings platform before turning things over to Mina and Alan to discuss what we've been able to accomplish with First Capital and our outlook for continued success through First Capital 2. As a brief reminder, Barings is a globally focused asset management firm overseeing approximately $380 billion across public and private markets for over 1,200 third-party clients worldwide. The most important takeaway on this slide is highlighted on bullet 2, which speaks to our unique ownership structure. As you may recall, Barings is a wholly owned subsidiary of MassMutual, which is a key differentiator for our clients as it provides a stable capital base that allows us to take advantage of market opportunities across asset classes over the full market cycle. Moreover, of the $380 billion in AUM I just mentioned, approximately 50% of that is managed on behalf of MassMutual's general investment account. This results in a significant alignment of interest that, with our partners, that materially impacts the way we think about investing. From our parent company to Barings GPs, having skin in the game and investing alongside our clients is a regular theme throughout our business model. If we move to the next slide, you'll find an outline of our investment capabilities, which gives you a sense of the breadth and depth of Barings' platform. At a high level, the platform is segmented by asset class across public fixed income, specialist equities, private credit, real estate, and private equity. In the interest of time, I won't go through each of these asset classes in details, but I will note that the funds and co-investments team is responsible for the management of First Capital 1. The group resides within our private equity vertical, and at nearly $5.5 billion in AUM represents a key area of growth for the broader business. Finally, turning to page 6, we'll highlight our commitment to sustainability and the framework that we've developed to promote a consistent approach across Barings' platform. What's important to note here is this. Concepts like sustainability and ESG are not just something we do for the sake of differentiation. They are core components to who we are as a firm. We believe that incorporating these tenets into our investment program not only helps to reduce risk, but actually enhances portfolio returns over time. And I think that's something that you'll see reflected in the work that Mina, Alan, and team have done with this mandate since 2018. With that, I'll turn it over to Mina to walk through the goals and objectives that we had for First Capital 1. Mina?
Thank you, Steve. So if we can turn to page 8. So in 2018, we had the pleasure of sitting in front of you for the first commitment to First Capital 1 at $75 million, where it was structured to focus on US-based co-investments. We've executed on plan and actually have done more for City of Philadelphia by adding a global component to that, as well as secondary opportunities. Today, we are fully invested and have performed well, with a 15.8% net return across 22 investments. We've looked at a number of opportunities since we started the program, over 1,100, and have only approved about 2% of the deals that we reviewed. The underlying portfolio is performing extremely well and is in part of the market that we have the most conviction, which is the small end of the market, lower middle market. So think about businesses with under 250 million of enterprise value, and also with emerging managers. It's fully diversified as you look across all the different sectors, and we believe that diversification is an important risk mitigator at the portfolio level. As a function of who we are, we're also proud to report that the portfolio is quite diverse. Steve mentioned sustainability, which also includes diversity. 55% of our portfolio has women in diversity either at the manager level, the company level, and at the board level. This is a reflection of who we are, but it's really driven by the fact that we believe that diversity leads to better outcomes, and our early performance reflects that. Not on the page here, but wanted to reiterate one point that Steve made, where there's tremendous alignment. In First Capital One, we've made a GP commitment of 1%. In addition to that, we as investors on our team have also made investments right alongside you. Furthermore, this portfolio benefits from the fact that this portfolio benefits from a number of relationships built over the last 30 years as our parent MassMutual has been investing in this segment of the market. And this portfolio reflects what we're doing for our parent MassMutual. It is our best ideas portfolio across our platform. So we're here asking you for your support for a re-up of $50 million. We're pleased to offer the same fee schedule that we provided to you last time at the $75 million mark, recognizing how much we value our partnership with the City of Philadelphia. So if we can switch to page 9. So page 9 here provides you an overview of what we've done for you in First Capital One. We believe that First Capital Two will mirror a lot of what we've done for you in First Capital One, and we expect that this mix will continue to drive the returns in your portfolio. As mentioned, we focus on the lower end of the market with best-in-class managers, and here you see the pies that give you our mix between the diversification, type, strategy, capitalization, and sector. Now I'll pass it on to Alan, who'll walk you through the details of your existing portfolio, some case studies, and also our process.
Thank you, Mina. And I would, if we could go to slide 10, and excuse the jackhammer in the back, of course, the day that we have a presentation. Want to provide, on page 10 here, some key takeaways on the First Capital Program One portfolio. You'll notice a lot of information on the slide here, highlighting the 22 underlying investments. You'll also note that the deal names have been sensitized due to confidentiality. Overall, though, we're reporting here that obviously Program One is fully committed. The portfolio is performing very well and in line with our targeted 18 to 20% gross returns. The portfolio is approximately 2/3 invested in the lower mid-market, which we define again as under 250 million of total enterprise value. We're happy to report that the program is mostly out of the J-curve due to early outperformance, and this is despite the young age of the portfolio, which has an average underlying investment age of just over 1 year. We're excited, and we are executing on the program as we said we would for Program One, and as Mina mentioned, we would expect Program Two to largely reflect this. Moving on to slide 11, we really want to emphasize that our primary objective here is to provide the best risk-adjusted return for our investors. Diversity is also important to us as it is part of who we are individually and who we are as a group. Mina and I are both SEO alumni and Twigo fellows, which provide us a natural network and touch points to have first looks and access to deals with high diversity components. We're proud, again, of First Capital's women diverse stats of 55% across either qualifying as portfolio companies, boards, or sponsors, and that is considering our relatively high benchmark of 33% threshold across those statistics. We also look to be helpful and influential to the extent that we have an opportunity to enhance a non-diversity board or company. We actually recently made an introduction to an African-American professional who was ultimately brought on to one of the City of Philadelphia's portfolio companies as a board member. I'll now walk you through some case studies to help put the portfolio to life. On slide 12, you'll see investment 7. This is a software company that provides OEM auto dealerships the ability to have a standard website across their brand, and it also helps these dealerships to manage their auto inventories seamlessly. It's a very sticky business. COVID actually highlighted the importance of having a well-functioning website and inventory management tool to sell their cars while the economy was shut down. These website providers also need to be pre-approved by these OEMs. Sometimes it's one of one or one of two providers that are approved to sell these services. So this provides a natural moat. We invested alongside a technology specialist, which also happens to be a diverse emerging manager. They look for differentiated business models with high recurring revenue, which this has, and high natural barriers to entry. The sponsor actually closed the investment Q4 of 2019, and we didn't actually invest till about a year later. This provided us the benefit to seeing how the company performed through the depth of COVID, which was quite impressive as it kept growing month over month. We were able to invest at cost on this opportunity, despite the sponsor valuing the asset at nearly 1.5 times at that point. The investment has continued to grow at 30% year over year, and actually EBITDA has improved by almost 150% since then. The business is now marked at 2.6 times, and there is a very high potential for a near-term exit at a premium to our current valuation. So this is an early winner in your portfolio, and we're excited about it. Moving on to the next opportunity I'll outline on slide 13 is investment 14. This is a company that provides direct-to-consumer footwear and apparel brand clothing to gym enthusiasts and CrossFit participants. We invested alongside an emerging manager that was previously the Advent International consumer team that had actually done the Lululemon investment. So they had extensive experience in this space. The business had grown 70% in 2020, despite the COVID environment and despite gyms being closed. We were able to invest, given the environment, with a lot of structured downside protection. We have a 1.5 times preferred equity investment behind zero net debt and ahead of all co-founder and team equity, which the management team and founders rolled 95% of their entire value behind us. The investment has greatly outperformed since closing earlier this year. The company actually displaced Reebok as the official apparel sponsor for some key sporting events that you would recognize. The brand also signed several successful ambassadors, including a 5-time gold medalist at the recent Tokyo Olympics, and also most recently signed a key athlete in the NFL as they expand their footprint into that sport. Overall, the company's running at over 100% year-on-year growth, and that is about 2% or 2 times higher than what we had projected, and even the management had projected. The deal still held at cost given the early hold period, but we also are highlighting this one as an early outperformer. On slide 14, I'll now hit on process and deal preferences and aversions. To start, we have a rigorous 3-step process, and we have a 6-person investment committee. Senior members are deeply involved across the process in underwriting underlying investments. We participate across the board, and we also help monitor the investments post-investment. In short, we take a cradle-to-grave approach. In looking at an investment, we first have to have conviction in the manager and the team. We like to partner with domain experts and sponsors and teams that have had experience, as evident in investment 7 and 14 that we highlighted just a couple slides ago. We also look for favorable deal dynamics. We like to see deal alignment, which is very critical to us, where we don't want to see managers just sell out of their positions. We like to see high rollover and high alignment. Structure, we like to structure downside protection where we can, and or have strong earning visibility into the near-term earnings potential of the business. We saw that on investment 7 and investment 14 here earlier, where we're again structurally senior to common equity, and we also had a 1-year look through at earnings for the second investment we highlighted. Obviously, the individual deals also have to stand as attractive investments on their own. So we look for long-term sustainable business models with leading platforms. They have to have strong unit economics, good strong customer retention, and most importantly, be in good and growing industries. So when we put it all together, we don't underwrite to binary outcomes. We're not doing, we're not looking for a 10 times return on investment. We'll take it, but we're not underwriting to that. We take more disciplined and conservative approach. We try to make it as repeatable and formulaic as possible. We focus again on segments of the market that we and our sponsors are familiar with. We don't just take information either, right? We do our own independent research and work. We write our own memos, synthesize our own financial models, do our own independent reference calling with our own domain experts, and have key management team meetings. Lastly, we're also able to leverage the broader $380+ billion Barings organization and its network along the way to attain a strong independent view on each of the transactions that we're underwriting. With that, I'll now hand it back to Mina to talk about sourcing and the pipeline.
Great. So if we can switch to page 16 of the deck. So as Alan mentioned, we have an extremely rigorous process. We see about 400 deals a year across all of our portfolio, whether it's emerging, established, in the lower middle market, women and diverse managers. This is an example here of some of the opportunities that we're currently pursuing, so you can get a flavor of it. It's also important to note that we're tracking opportunities in the Philadelphia and in the broad Pennsylvania area. And I'll highlight Project C, which is a Philadelphia-based opportunity where we've been in touch with the CEO and the sponsor, who also happens to be a diverse manager, for their next round. And that company is a tech firm that's developed a model to break the cycle of immense food waste that's going on in our country. So this is only a subset of what we have to offer, but gives you a sense of the size and the deals that we're reviewing. And last, on page 17, I'll end the presentation with our term sheet, which should be very familiar to you since we reflected the same terms in First Capital 2 as we did for First Capital 1. On behalf of Barings, my team here at FCI, I wanted to thank you all for your consideration and the opportunity to continue to serve as a fiduciary for the City of Philadelphia. And now I'll open it up to questions.
Thanks a lot. Thank you for the presentation. One thing, the case studies you gave were really helpful. Do you also have examples where investment didn't work out? And then kind of how do you handle that?
Yeah. So absolutely. One of the things that Alan mentioned, I think is important to note, is the average age of investments here is actually 1.2 years. So we're very, very early on in our portfolio. I would say one of the opportunities that I wanted to bring up where we made an investment right before COVID is a business that provides healthy, natural cough and syrups. It's actually a 100-year-old brand. And most of their products, so if you have kids that are home and sick, with a cough or the flu, you want to give an alternative natural option. So as you all know, in the middle of COVID, no kids were going to school. No one was really getting sick. So we did see in that situation a dip in the revenues and of course reflective in the EBITDA. However, the company did take advantage of that time to really improve just their supply chain, their operations. They had just built a plant. Now, unfortunately, right now kids are back at school. We've seen an uptick as kids are getting the sniffles and so forth. So that's a really good example of that, where we're always looking to, we won't always get everything right. No one would have predicted something like COVID where, the world was shut down. But at the end of the day, it goes back to what Alan said. It's not just about the company. It's about the company, the management team, and the sponsor, and do they have experience investing through different cycles? And that is why we go through that. The second thing is what's important to build a diversified portfolio. If we would have built our portfolio with only consumer, you would have had more volatility in the portfolio. And as we kind of referenced earlier, I think it was on page 9, you could see we provided, we've built a portfolio with 22 investments and a lot of diversification across the board.
Thanks.
So when a deal comes to the investment team, does it have to be approved unanimously?
No, we do not require unanimous. It just requires majority.
And how often does the investment team meet?
We meet weekly. So there's, maybe I'll just take a step back and say, Alan referenced a 3-step process. So for every deal, we formally meet in the investment committee on a weekly basis to review those deals. In addition to that, we have a what we call investment IM, so investment management, where we as the whole team vet these opportunities. So we do that in addition to our investment committee on a weekly basis as well, where we're going through the models. The whole team is engaged and involved. Our memos are shared. And so what this means and why we add that kind of preliminary step is just to give the deal teams an opportunity to ask questions, see if we have any other touch points in the sector, we have any other things that maybe the deal team has not thought of on their own. So it's another level of kind of to add some rigor to our process as a general matter. But the formal IC meets on a weekly basis.
So, so you said the deals are majority of the team. So can there be a tie? And if there is a tie, who decides?
So we have 6 people. So if it's 3 or 3, that does not get approved.
Okay, thanks.
And just to follow up, is there anyone on the committee who has a veto? Is there like one person who can say no, or is everyone kind of even on the committee?
Everybody is even.
Okay.
In our initial staff presentation, it was explained to us that in First Capital One, there was a somewhat slow early deployment, and that the mandate was expanded to include global opportunities and to some extent secondary opportunities. Did that alleviate the slow deployment? I think it indicates that it did, but do you anticipate any problems with deployment going forward in a First Capital II fund?
Yeah, and so you're absolutely right. So when we first started the program, we were not very excited about a lot of opportunities, but I would say that it was a global comment, right? It was we were not excited about anything in the US and on the global basis. Through COVID, what we found was there were a lot of opportunities, especially on the secondary side. And so when the program was amended to include not only the secondaries, but also just broadly from a global perspective. From what we see today, I mean, right now we currently have, and we're in full diligence, we shared with you the pipeline. I don't expect us to have any issues in terms from a deployment standpoint. I obviously can't control how the markets ebb and flow. We've also heard the news.
It'd be kind of cool if you could, then, you know.
I'm sorry?
It'd be kind of cool if you could.
I know, then I probably wouldn't be here. I'd be on some special island or something, but or in space now, which I feel like is the new kind of thing to do. But in any event, but that is why when we see good opportunities, we deploy capital. Our activity in 2020 was quite strong. We took advantage of a lot of when a lot of managers and a lot of people were just holding back. They were frankly triaging their existing portfolios. We were pretty aggressive at that point in time with our managers who were nimble, weren't saddled by their legacy portfolios and saw opportunities in the market. So so far, you know, we're very excited about First Capital II. And this is also the benefit we share on a monthly basis. We do have calls with your staff and share with them our activity. We're pretty transparent in terms of how we see deals in the market. So they have that kind of real-time feedback as we manage either First Capital 1 and 2.
And meaning you don't see any problem with sourcing given the large influx of capital currently into the private equity world?
So I'll tell you the good news is that most of the influx is actually going to the larger end of the market. If you look at 10 years ago, about the 40, 50%, 30 to 40% of the activity was in that $1 billion plus segment of the market. Today, it's about 70, 80%. And as I mentioned earlier, we're really focused on that lower end of the market, smaller deals, smaller transactions. So yes, broadly, the asset class has grown, but it really hasn't grown in this segment of the market, which is precisely why we have so much conviction in the lower end of the market.
And finally, just one other question. Although this is not law yet, there's been talk about the change in the holding period and tax favorability for private equity. Would that have any effect on your investment decisions, given that they're smaller investments?
No, I think it'll, if it comes through, it'll impact, it'll impact whether it's a small or large end of the market. What I will say is, where as an LP myself, where I'm going to be focusing on is making sure that, you know, fees aren't changed, right? Because you don't want managers to increase their fees to make up for a reduction in carry. At the end of the day, this is where the alignment is really important. Like I mentioned, our 1% alignment is critical. We only get paid on a net basis after, frankly, we've returned all the capital, fees, expenses, and all of that. So it's an aggregate waterfall. So we'll see. We'll see how the market changes, but I don't anticipate that. You know, we'll see probably a bigger impact on the larger end of the market versus kind of in the smaller end.
Thank you.
Any other questions? Okay, thank you very much.
Thank you for your time. Really appreciate it.
Thank you.
Thank you.
Are we clear, Bill?
Not yet. Give me 1 second.
Okay.
Okay. And you're clear.
Great. Any questions or discussion? Not, is there a motion?
I'll make a motion to approve.
There a second?
I'll second.
Great. Motion's been moved and properly seconded. Brian?
I approve.
I approve.
Leontine?
Approve.
Vanessa?
I approve.
Carol?
Approve.
Ron?
I approve.
Kellen?
Approve.
Motion carries. Thank you very much. That takes us to the investment performance update.
Thank you. Briefly review the portfolio returns at a high level, and then have Marquette make any additional comments, as well as provide a brief update on International Equity Manager (SGA). August performance was strong, 1.5% positive return, which was 20 basis points ahead of the benchmark. And you can see that the 3-month, year-to-date, fiscal year, and 1-year numbers on a net of fee basis all show outperformance. We provided the estimates via email, the preliminary numbers through the 21st of September. The fiscal year number, we're about 20 basis points ahead of the benchmark. Year to date, around 55 ahead of the benchmark, and then month to date, almost right in line, 3 basis points behind on a preliminary basis. There has been some increased volatility in the market over the last week or two, particularly with some of the news coming out of China around possible issues related to real estate firms and debt defaults. There's also, increasing noise coming out of Washington about government shutdowns, about defaults on outstanding debt. Notwithstanding all that, the market over the last 2 days, at least as of a few minutes ago, is now rallied to a point where we're back ahead, the Dow and the Russell ahead of where we were Monday morning when the markets opened. I would anticipate, Marquette can certainly comment, I would anticipate seeing some increased volatility, particularly in the next 2 to 4 weeks. No actionable concerns on any of the managers. As a whole, they broadly continue to perform well, particularly over longer term time periods. We will have updated numbers on the open-end core real estate managers at the October meeting as they provide data quarterly. And with that, I'll pass it over to Kwaku and Dave on SGA and any other comments they have. Of course, we're happy to take questions if there are any from the trustees.
Thanks.
Good morning, everybody. This is Dave. So Chris mentioned we have one manager where we've done some additional diligence. We have within the portfolio 2 non-US small cap managers. Non-US small cap is an area of the market where we do think that there is informational inefficiency, meaning that managers can't extract value. We also expect to see periods of higher tracking, periods of higher volatility in an asset class like this. These tend to be less followed than U.S. equities, less followed than U.S. small cap equities. So it's not surprising to see periods of volatility. We have been disappointed really from the early stages by SGA, especially compared to the other non-U.S. small cap manager. And those differences, or that underperformance difference, is largely attributable to more of a value bias, more of a bias towards cyclicals and strategies that are underlying sectors that have not performed as well as, say, some more growth or core biased non-US small cap managers. During the cyclical market rally that really started in November of last year, where sectors like energy, industrials, materials, financials performed very well, especially following global reopening of an easing of COVID, massive amounts of stimulus, we did see a rise in performance. So while we've been sort of disappointed from the earlier stages, we have seen performance that's consistent with what we would expect from a manager that overweights strategies or overweights underlying factors like value and quality. Those are value and quality in particular have performed poorly over the the previous 2 or 3 years, but have rebounded significantly during a period where markets have improved. Now, of course, we're back in an environment where there may be some more downward pressure on cyclicals as a result of the COVID or the Delta variant, but we've seen an upswing in performance as expected during a backdrop like this. I'm happy to provide any other color with respect to that memo or anything else that may be on your mind.
Just to make sure I understand, is what they're doing consistent with what we thought they were going to do when we brought them on, or has there been any kind of straying from that?
No, sir, there is not. They are a quantitative focused manager, meaning that they are making security selections based really on 4 different factors. Those factors are profiled in the first paragraph, and those factors tend to overweight things or characteristics like value and quality. And they are consistent with what we had expected them to do. No deviations from their initial strategy or initial proposal.
Okay, so even though their performance may have been off, they are giving the balance to the portfolio that we expected when we first brought them in.
Yes, sir, that's exactly right. Diversity of stock selection is just as important as diversity of asset class, especially in a market for asset class like this, where we would expect to see probably more volatility than, say, U.S. large cap equity.
Okay, thanks. Any other questions? Okay. Anything that Marquette wanted to say about overall performance, or should we move on to staff report?
Maybe just to reiterate the comments that Chris already made, the 2Q performance in July, performance in August is largely attributable to very attractive earnings growth from U.S. large or U.S. companies, non-U.S. or European equities. And that tailwind has been very helpful. Some of the volatility that we've experienced lately is attributable to, maybe challenges within the Chinese tech market and some more transparency around what may lay ahead from the Federal Reserve as they start to perhaps taper or stop or slow down their purchasing of securities within the Federal Reserve. September historically is a down month. It's really the only down month across the board, but more volatility, especially this time of year, and especially given the backdrop of tapering interest rate challenges, inflationary pressures. More volatility is certainly something that we could expect.
That being said, and you don't have to answer this if you're not ready, other than government and some other problems that are going to rock the market in the short term, do you feel like valuations are still pretty low, even based on the high index numbers?
Valuations are at basically all-time high levels, whether it's U.S. equity, fixed income, private equity. However, in an environment where we have very low interest rates, those valuations can be supported. And until we start to see a material increase in interest rates and a weighted average cost of capital, these valuations are still reasonable. And we don't anticipate seeing a dramatic shift in short-term interest rates anytime, at least in the next 2 years.
Okay, man. Thank you.
Any other questions? Okay, let's go on to staff's report.
Thanks, Dave. Securities lending income for the month, just under $79,000. On a year-to-date basis, the fund has earned $662,000 and change. And since the inception of the program, a little over $50.1 million in securities lending income. Diversity and local AUM on a combined basis, roughly 26.1%. Diverse managers broken out into their own group, 19.1%, and local managers just under 9.6%. Upcoming board meetings, the next meeting is scheduled for October 28th. The November-December schedule is to be determined by the trustees, and the first meeting of 2022 is scheduled for January 27th.
Thanks, Chris. Any questions?
Hey, why don't you just go ahead and schedule the November-December meeting now for December the 9th, so everybody can put it on their schedule. That's what we've done the past few years, combine the two.
Yeah, it's fine with me if it's okay with the other trustees.
I'm just trying to be helpful here.
You always are. Thank you. Now, hearing no objection, let's go with that.
Thank you.
So
I'm
won't
sorry,
be a
Robert.
November meeting, right? It's going to
Sorry.
be a November and December meeting, and
Yes.
on December 9th.
Right.
Okay, that works. Thank you.
Great. Okay. No other questions? Any new business? Old business? Hearing none. There's a motion to adjourn that's been made and properly seconded, and we are adjourned. Let's go into the full board meeting. It's been moved and properly seconded that we accept the recommendations of the investment committee. I will call the roll. Brian?
I approve.
Francois?
Approve.
Leontine?
Approve.
Vanessa?
I approve.
Carol?
Approve.
Ron?
I approve.
Kellen?
Approve.
Great. Any new business? Old business? It has been moved and properly seconded that we're adjourned. So thank you all, and we'll see you in a month.
Bye-bye. Have a good day.
Bye, everybody.
Thanks, everyone.
Thank you.
Have a good day, everybody.
Bye.